We can start. So today we're looking at the theoretical aspect of capital allowances. Um, so the structure of the exam is question one. For the most part, you come across computation of capital allowances, computation of taxable profit, and then the actual computation of tax. Depending on the nature of the business that you're given, it can either be a partnership, a company, or a sole trader. But the computation of capital allowances is the same across the board, despite there might be a few differences here and there. And then also computation of taxable profits is virtually the same, but there are certain additions with respect to partnership or a company. And then computation of tax, of course, it varies depending on the business structure that you're working with. So in this lesson, we're looking at capital allowances. So firstly, the exam approach. This is what you're going to come across in the exam. You're going to first, calculate the capital allowances, and then subsequently you compute the taxable profit, and then you compute the amount of tax payable. So this is just something I spoke about. So in this question, or rather in this section, it begins with taxable profits, but we'll come back to these notes when we start looking at taxable profit. But we'll skip to capital allowances. So today we're looking at capital allowances as I already mentioned. So what are capital allowances? What you need to know is this. In financial accounting, financial reporting, advanced financial reporting, you come across what's called depreciation. This is where you're trying to write off the cost of an asset so that at the end of its useful life, the value is zero, right? So that you can write it off from your books. But the situation here is for tax purposes, ZRS says no, we do not accept the depreciation that you charge to your assets. Therefore, we're going to give you our own depreciation that we call capital allowances. So, in essence, capital allowance is just a depreciation that is given for tax purposes. And then this depreciation is given on implement, plant, and equipment, and then on industrial buildings, on commercial buildings, as well as farm works and farm improvements. So we're going to look at each and every item in more detail. So implement, plant, and machinery. For the most part, what you're going to be coming across in implement, plant, and machinery is motor vehicles. So motor vehicles, these are the items that you're going to be coming across for the most part. So motor vehicles, and then implement, plant, and machinery also includes things like machines that are used in manufacturing, things like computers, things like other equipment, or maybe fixtures and fittings, you know, any other item that is used in the business, right? That is categorized as, an item that is used in the business, right? So for the most part, you're becoming across motor vehicles, and then these motor vehicles are classified into two, right? There's commercial vehicles and then there's non-commercial vehicles. So when you're calculating the capital allowances, there's a percentage that we charge, right? Which we multiply by the cost of a particular item. So for general implement, plant and machinery, things like, computers, other equipment that is not used in machinery or rather in manufacturing, we charge 25%. So I'm going to show you how we do this when we go through a question. And then commercial vehicles. What are commercial vehicles? Commercial vehicles, these are vehicles that are used in the delivery of goods or services. So for instance, a truck, right? A truck, or maybe a Toyota Canter or a Mitsubishi Canter rather, all those vehicles, vans that are used in the delivery of goods or services and they're not used for personal use, those are commercial vehicles. And then non-commercial vehicles, these are other vehicles that are used for personal use, mostly sedans, hatchbacks, right? So these are the vehicles that are used for personal use. And then the rate is 20%. For commercial vehicles is 25%. And then any other implement, plant and machinery is 25%. And then machinery that is used in the manufacturing, that it's 50%. So if you've got equipment or rather machinery that is used specifically for manufacturing, 50% is charged as capital allowance, right? And the other point I didn't mention is capital allowances that are charged on a wear and tear basis, right? So you write off the capital allowance every year. So for the most part, the capital allowances, they are straight line based, right? So the same amount, the same percentage multiplied by the cost, that's what you deduct across the years, right? And then for a sole trader, there's what we call divided use. So these capital allowances, remember, this is tax depreciation. This tax depreciation is recovered in full if that particular asset is used wholly for the business. But now, if there's divided use, maybe the sole trader uses maybe a delivery van for personal use as well as for business use. The capital allowance that you recover is that which is specifically for business use. So in the exam, you'll be given a percentage of business use and a percentage for personal use. So once you calculate the capital allowance by saying the rate, let's say 20% for a non-commercial vehicle, you multiply by the cost and then you multiply by the business use so that you can be able to recover the capital allowance that is relating to the business use. Sometimes you won't be given the percentage, sometimes you'll be given the business mileage, right? So you can be able to calculate the proportions that way. And then capital allowances that are given each and every year per annum until that asset is written off or sold. So if let's say the asset has got a useful life of 4 years and then it's sold in the fourth year, the capital allowances are given 3 years, right? So year one, year two, and then year three. In year four, you don't give capital allowances. You arrive at what's called a balancing allowance or a balancing charge. So depending on the nature of the transaction. So how do we find the balancing allowance? How do we find the balancing charge, right? So a balancing allowance, right? In simple terms, right, is what we call the ITV, which is called the income tax value. So this income tax value is arrived at by getting the cost and then you deduct the capital allowances. So after you deduct the capital allowances, it's going to give us what's called the income tax value. So this income tax value, you have to match it against the disposal proceeds. How much are we selling this asset for? So after we match it against the disposal profits, the disposal proceeds, there's either going to be a positive or a negative figure. So you say the income tax value, let's say maybe it's just, for argument's sake, it's 100. And then the disposal proceeds, they are 120, right? And then in another scenario, the disposal proceeds are 80, right? So for us to get a balancing allowance, right, the disposal proceeds have to be lower than the income tax value. So we say 100 minus 80, it's going to give us 20. And that's 20 because the disposal proceeds are less than the income tax value. It simply means we have a balancing allowance. And then in a situation where the disposal proceeds exceed the income tax value, we're going to have what's called a balancing charge. So this balancing charge is deducted from the rest of the capital allowances that we calculate, right? So the balancing charge, this is where the disposal proceeds exceed the income tax value. And then the point that we also need to remember is the residual value, or rather the disposal proceeds, should not exceed the cost. So in our situation here, if our income tax value is 100 and then the cost of the asset is 150, the disposal proceeds are not supposed to exceed 150. So let's say if they're 170, we need to limit the disposal proceeds to what? 150. And this 150, that's one we match against the income tax value. I don't know if anybody has got a question so far. No question?
No.
Okay, so let's carry on. So now there's this other, theory which is not very relevant for exam purposes, but there's lease and hire purchase. So for a finance lease, capital allowance is claimable. So in financial reporting, a finance lease, this is a lease where you obtain an asset for a period of time called the lease term, right? And then you treat that particular asset as though it's yours, right? Until that lease period ends, and then you'll be depreciating it because the standard IFRS 16 requires you to do that. And then for tax purposes, we also treat it as though it's our asset, and then we recover the capital allowances. And then for an operating lease, right, the standard IFRS 16 says an operating lease, you don't treat the asset as if it's your own, right? You only pay lease payments which you expense. So operating lease, right, capital allowances are not claimable. Then hire purchase, the capital allowance is claimable at the contract cost, right? So this is just some additional theory that is not really as relevant. Um, then let's look at the capital allowances for the buildings, right? So capital allowances for the buildings, the thing that you need to understand is this: there are two types of buildings. There's industrial buildings and then there's commercial buildings. So forgetting all these theory that's here, industrial building simply means a building that is used for the manufacturing of certain goods, right? So you use it for manufacturing, number one. Number two, you use it for the storage of raw materials that you're going to use in the manufacturing process. Number three, you also store the finished goods that are used in, or rather, the finished goods that are produced from the manufacturing of those goods. And then these are industrial buildings. It also includes hotels and then also low cost housing like staff canteen and the likes, right? Those are industrial buildings. The key word is industrial buildings are used for manufacturing purposes, producing some form of goods. And then commercial buildings, these are administrative in nature, right? They're not used in the manufacturing, but they're just used for the purpose of administration of the business, right? So things like, head offices, things like warehouses, right? Warehouses that do not store goods that have been used in the manufacturing or raw materials, but other goods, or rather finished goods, right, that you're going to resell. Retail buildings, showrooms, right? All those are commercial buildings. They're not used in the manufacture of goods that are going to be subsequently sold, right? And then there's also what we call qualifying buildings, right? So as I already mentioned, so buildings used in the industrial purposes, including manufacturing, milling, storage of raw materials or finished goods on import or export, and then hotels as well as low cost housing. So low cost housing, this is fundamentally a staff canteen, right? And then the qualifying cost is, 100,000. So the low cost housing or staff canteen is limited to 100,000. It shouldn't exceed. So if you've got a staff canteen which is 150,000, you limit it to 100,000. Therefore, capital allowances are calculated on that 100,000. Then non-qualifying buildings, that's for industrial buildings. dwelling houses, rental shops, showrooms, offices, buildings used for retail trade, repair, or servicing trade. So basically, the commercial buildings, these are non qualifying buildings for industrial purposes. And then the qualifying cost. So there are certain situations where you've got a building, it has got both a commercial component and an industrial component, right? So in that situation, you need to establish whether you're going to include the commercial component as part of the industrial component, right? Um, there's a way that we are supposed to calculate that qualifying cost. But for now, we're just sticking to the theory. But when we go through a question, you'll be able to see how we calculate. Because even though I try to explain and tell you now, it won't make sense. But the qualifying cost, if you've got a building that has got both a commercial and industrial component, you need to establish, right, whether that commercial component should be treated as an industrial component. And what's the criterion, right? You need to get the total cost to deduct the land, and then you multiply by 10%. And then from there, you need to match that 10% of the cost, right, with the total cost of the commercial component, and then therefore you can be able to arrive at the decision and conclusion depending on the results. So I will explain when we go through a question. For now, let's just stick to the theory, right? Then how do we calculate the capital allowances on industrial buildings? So it depends on whether the building was constructed or the building was not. So if the building was constructed, the three types of capital allowances that we give. There's the initial allowance, right? There's the investment allowance, and then there's the wear and tear allowance. So initial allowance is 10% of the cost, but this initial allowance is only given on new buildings, a building that is being used for the first time. So when you construct a building, you are using it for the first time, you give this initial allowance of 10%. And then investment allowance, by virtue of you constructing this building, you're going to give this investment allowance, right? And then also you give a wear and tear allowance. So if a building was constructed, right, you give three types of allowances: initial allowance, investment allowance, and wear and tear allowance. So initial allowance in the first year of use, 10%, right? Also the investment allowance 10%, wear and tear allowance 5%. So these two, initial allowance, investment allowance, they're only for the first year of use. The subsequent years, you only give the wear and tear allowance. Therefore, if an asset, or rather a building, was purchased second hand, right, the only allowance you give is wear and tear allowance. But if a building is new, right, you didn't construct it, you just bought it new, it's never been used before, you give initial allowance and wear and tear allowance, which are given at the rates of 10% and 5% respectively. All right, I don't know if it's clear. Right. So, but for commercial buildings, there's not so much, right? We only give 2%. So it's only 2%, 2% of the costs, so whatever cost that you have, you give 2%, right? That's the wear and tear allowance, right? Then there's a situation um, where there's capital allowances and VAT. Even this, the theory doesn't really make sense unless we actually go through a question. But the thing is, uh, remember when we learned VAT, Ahmed, we learned VAT. Jacqueline, we haven't yet learned VAT. But oh, I think we have. We have Jacqueline, right?
Yes, we
Yeah, yeah,
have.
yeah. So VAT on items or assets that are used in the business, you recover, right? That input VAT. But again, if an asset is VAT inclusive, right? And then you claim capital allowances, it means you are double accounting because that VAT is going to be claimed, right? And then again, when you're calculating capital allowances, you inflate the cost because the cost is inclusive of VAT, right? So when we're dealing with the situation of capital allowances and value added tax, right, we need to remove the value added tax if the cost is VAT inclusive, right? And then if that VAT will be recovered in the future, or rather, if that VAT will be recovered when we are, computing the value added tax, that's if that asset is it's claimable, right? Uh, we remove the value added tax by multiplying by a factor of 25 over 29, which is just 1 minus 4 over 29. But if, the VAT won't be recovered for things like personal to holder, puka, right? You just, keep the cost as it is because the cost is VAT inclusive, and then you will not claim it. So you can, claim it from the perspective of capital allowances, right? With that said, that's it for capital allowances. So the next time we meet, we're actually going to go through the practical aspect of capital allowances. We're going to compute the capital allowances. I don't know if anybody has a question or any need for clarification.
No, we have a question. Kindly share the video
I
or
didn't
the
get that. I didn't
recording
get
rather.
that.
Kindly share the recording rather.
No, you're not audible, Jacqueline. I think I don't know. Mic is not clear.
So I was saying that no, everything is clear. Just share the recording.
Okay, all right, no problem.
I don't know if you can hear. Okay.
All right. Okay. So tomorrow, well, not tomorrow. Tomorrow is Wednesday, Thursday. Well, wait, yeah, tomorrow, of course. Yeah, it's tomorrow. So tomorrow, we're going to, practice with an exam question so that we understand how we apply the theory we've learned. Hello, Ahmed.
All right. Thank you.
Yes, okay, thank you very much.
All right.
Maybe I think it will make more sense when we do the practical aspect.
Yeah. All right. Okay.
Okay, thank you.